Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to be discussing how to auto trade and optimize your backtests in the dashboard. Matt, do you want to share a screen and get us started?
Sure. Yeah, so let's just step back. So what you want to do is we're going through these back tests. We have pre-run back tests. We have ways to run your own back test. So you see how it works, but you also want to then run it in a forward test. And that's really what auto trading does, is it forward tests your back tests, and then you could get further confidence that the backtest is working, or see that it's not working. For example, if you overfit. So the problem with optimizing sometimes is that you can overfit the backtest, which is to say that you have this line of the returns of a particular backtest, and if you could optimize it so much that it will not really work in the real world. So this is what we've done it for. So again, you could go to the browse backtest. You start you could go to this. If you click up here, you get all the things that we could do in ORATS. There's backtesting. We talk about it. There's scanning, and so I'm going to go to browse just to see here. So I might I want to see. I had a question from one of my webinars, like, when is a good signal, or what is a good signal to get into put spreads and protect your position? Because I have been very protected in this time, and I want to show people like how I know to get in at particular times. So I'm gonna look for a put spread that's in the market quite a bit. So I want it to be like 98% of the time, and I want more in the money and not too long term. So I want to be like between 44 and 99 days, and have my delta be at least I don't know, 22 and 44. And then not use any, select none of the entry triggers, because I'm going to set up my entry triggers. I kind of don't want spread the stock ratios in here. I'm going to take that out too. So I'm okay with having exit triggers. I think that's actually kind of good to get, to have a way to get out of these. But you'll see that the returns are fairly poor on these. What's happening in a long put spread is you're just like, it's almost like a long put. I'm just protecting my position. So, I want Go
Can
ahead.
you scroll over to the annual return during the bear market?
Sure. Yeah, that's a good point. So one of the things that we do is we show the annual returns, and you could set these. Like last year, I don't want to have lost 3%, right? So I want my max to be negative, under that. Or sorry, I did it wrong. I want the minimum. The minimum. Yeah. So I want it to be, I don't want to have lost 3%. And then in the bear markets, I want it to have made a good amount. So at least, let's just say 8%, right? Is that what you're getting at, Tyler?
Yeah. I mean, I want to show that we have that annual return during bear market for this exact point. This backtest, this browse backtest tab is a really kind of unique workflow. I don't think a lot of people are used to sort of doing back testing this way. Every other back tester I've seen, you key whack your numbers in and then you run them. But this is a whole different tool.
Yeah, good point. So now we have a back test that works well in bear markets that didn't do too poorly last year, and doesn't do that poorly even in bull markets. So let's see here. So this is the look of it. So now we want to say, well, I don't want to be in this time. like maybe we have, a less of a protective strategy, like a put calendar or something like that. So people ask me like, when do you have put calendars on? When do you have long put spreads? And when do you have long puts on? And usually that's the progression. Like through these times, I'll have put calendars, and they'll kind of do okay, and they'll do pretty well, but not as well as this does in bad times. Does that make sense so far, Tyler?
Yeah.
So let's optimize this, and it may or may not work the way I want it to work, but we'll see. So when you optimize, you add a data set. I usually sort on p-value. I usually like to see something that makes sense, that's simple, like a a volatility type thing here. Forecasts of volatility. I actually like to look for longer term volatility, because I want a longer indicator. So IV60. So I might do something like this, XERN IV60. Now, we know that XERN IVs, there's no earnings in SPY, but it at least allows for it, if we're looking at a stock. So I'm going to check this out. So what I want is I want a longer term, which is not 10 days, and I want to get in when the volatility starts rising. So I just know that I want to do that. So I'm gonna take this out, and I'm gonna put an indicator in here. So I want a longer term SMA, a moving average, and let's see if it did it the right way. No, so this is getting in when it's underneath, and we'll explain why that happens. But I want it to be over and get out when it comes back down. So then what I'm seeing now is, it got me in when I kind of got in, during this kind of market crash Iranian thing that we're in right now. But also, in the April kind of tariff situation, when the market started going, then the vol started coming up, and what we could do is, I know you always ask me to do this, time. So I'm zooming in.
Yeah, I can see it a lot clearer now.
Yeah. So, so now this is that April, right? And I could minimize this a little bit. So, it started coming up, and we missed a little bit of it, right? But then we got it, like with the green. So the green is, look what the green says. So the green is the long put spread with the signals, okay? And the gold is just, or the orange is just the normal equity line. So, and then what we could do is you always tell me to do this, is zoom way out, and then you could see how the whole thing performed, right?
Yep.
So you could go, so there's 2007. You could see the green line is significantly better than the gold line, right? So this is what we want. We want to be out during, these kind of market rallies and such. So this is the type of indicator and the type of SMA that I like to do. And there are other things that you could do to, there are some times when it gets in, when it's kind of flat, and it's getting in and it's getting out. But this is a time, this is a good indicator that I like to use, Tyler.
Yeah. It looks good. And there were some others that also looked good on that data set indicator list too. So I think this one's ripe for some indicators. It doesn't happen on every strategy. It's
Right.
kind of depends on the strategy. Don't get discouraged if you pull up a strategy and there's no good indicators, because it does happen sometimes. It has to be a strategy that I would say lends itself to, I guess, having timing. And if you can time it with the volatility surface, then ORATS indicators are very much related to that. So I would say that's generally a good.
Yeah, what I would say is a strategy that's least related to a stock strategy, meaning like that has the lowest correlation to actually these candles. Like, so when this goes up, either negative or positive correlation, because that is something that, it's difficult to predict stock price, right? But
Right.
but a lot of our indicators can predict when a strategy might be doing well. And so
Right.
when I see the higher p values. So let's go ahead and we like the strategy, right? So, again, it doesn't make money, but it will protect you in bad situations. So I've saved this 75-day, and then what you do is you go to your save backtest. Now, I have a bunch of save backtests that I'm running and using and testing and all that. So, when I try, so it's sorted by date over here, March 23rd. So these are the ones I've run today. So this is the type of strategy that I'd like to get into, and I'll then I'll auto trade it. So I've clicked here, and then what that means is this auto trade will get in like the back test. So what we're trying to do now is we're trying to recreate the back test. So we're getting in when the back test would normally get in. So we want to see consistency. So we're just, we're getting in at 15 minutes or 14 minutes before the close. That's when our near end of day back tester does its trading. Right before
It'll fire off once a day. It'll check.
Right. It'll fire. Yeah. If it matches. Right. So,
right.
So the back test that we have going, it has to match that back test. So it has to, do the things, and, mine gets in every 15 days, and you only have one on. So it won't do it every day. It'll just do it after you close one, it'll get in, or after 15 days, it'll get in.
Right.
So,
and that's designed to mirror the browse backtest table as well as the optimizer.
Right. Yeah. Yeah. You want to so what we're trying to do is we're trying to, and let me just SPY. Yeah. So what we're trying to do is and I'll just turn this on. We're trying to recreate this test. We're trying to, it's hard to see, but we're trying to recreate this, the test that we've a test that we've identified.
Yeah.
Actually, this one. So, yeah, this is what we want to see is in the reason it's not all the way up. We update it periodically, but what we'll want to see is in our so now the next step is okay, so we're doing this auto trading, right? So if you go to your positions and you go to ORATS paper trading auto trade, you'll see a bunch of positions here. And then what you could do is you could say, well, how is it doing? So I go to the trade journal, and then I could see, okay, so here's a trade journal since February, and I could look by underlying. So I could go down to SPY, and then that will again narrow the strategies. I could look at my long put spread and see these trades, right? So I could see how the P&L has looked, and when it got in, and when everything's gone. And it's been doing well because again, when that volatility starts to rise, that's usually a good time for these long put spreads. And conversely, we're going to want to see when that when the opposite is true, right? So we want to see when when to get out, right? So we're going to want to see so in April, for example, so we had the Trump or Liberation Day or whatever you call it, but the market, so the strategy made a lot of money, but then it gave back a lot, right? So, you know, this particular indicator, you know, is relatively slow, you know, but it got you in and it got you out. So I mean, and it protected your, you know, it protected your position, you know. So this might be a little bit slow to get out, but you know, again, you could get a little, you could further optimize it. You don't need to use the exact exits that we're using here, you know, where you do the opposite of the when the 20-day rises or goes below the 50 days when this gets out, right? So this didn't get out, you know, till here. Like, so this blue line is the fast line, is the 20-day, and then you know, it didn't cross till here, and you know, the market had already rallied quite a bit, so it's a little bit slow. And again, you could, you know, if you wanted to make it quicker, there are ways to do that. You know, you could look at the slope of this and do things along those lines. But what I like is what it gets us, you know, it gets me in, you know, and then I kind of can, you know, manage my positions around, you know, around having that extra protection. So right now in my protection account, I'm, you know, like, you know, if it rallies, I make money in my stock positions, but if it goes down, I'm very protected. So right now I've got kind of a call, you know, and it's expensive. There's theta, but and there's a lot of vega, meaning I own a lot of options, but I'll take it right now because who knows what's going to happen. I mean, you could go down 40%, you could go down 30%, you know, and you know, I would almost break even at those points. I have so many put spreads on right now. And if it rallies, I kind of break even, and then I'll get out. And then as the market then continues up, that's when you make your money in the market. So that's the philosophy that I follow, Tyler.
Yeah. Speaking of sort of risk assessment, you can probably check that out in the risk profile and see your portfolio risk, right?
Right. Yeah. So I mean, I could just pull up, you know, for example, I could just pull up SPY, and I have a bunch of positions on right now, as you can see. You know, I could view that in the portfolio page, and you saw how many there were. So it takes a second, but you know, you can see that I'm, you know, fairly short. So like I'm negative 216 delta short. I've got a fair amount of gamma, a fair amount of theta and vega. So you know, now my puts are kind of in the money because you know, so now I'm just kind of short. You know, you'd think about potentially getting out of some of these, but you know, what I do is I wait till my signals have gone the other way. I don't mind losing a little bit, just making sure that you know, the market is past the worst is kind of how I think about it.
Yeah. Do you have more there? Do you want to zoom out? I think you might have.
Oh yeah, yeah, definitely have more.
Wow.
So as I
So
zoom out,
it actually kind of comes back around.
what's that? Oh yeah, it comes up here. You know, I do have some calls over here. So, but yeah, you could see all, you know, there's like, so here's the normal, here's the, not the normal distribution, but here's the distribution of actual stock movements. And so now we're way outside of the tails, you know, for some of these, but some of these positions. But you know, it's good to see, like, this is what I like to have, like a lot of little wings out here.
Yeah. Awesome.
Yeah, but yeah, no, but the risk profile is awesome. You know, you could see, you know, that now I know, like, you know, I know what my, you know, what my delta is, right? So, and I could, you know, I could look at my delta over time as well. So, you know, and I could see it's 200 here, and you know, going up. So, I know that it's going to protect, you know, my ETFs that I have on. So,
so that distribution there, just a quick note, is only a 3-day distribution.
right.
So yeah, if you're wondering why isn't that wider, it's just it's looking at what's going to happen over the next 3 days.
Right. And if you wanted to see, for example, a wider distribution, you could look at it at an individual trade. That might be. So I'll unclick that. So here's a 99-day trade, right? So in the 99-day trade, we map that distribution. So now it goes all the way down to 400, where it's only going to 600 before.
Yeah.
So it looks a lot. This distribution looks a lot different.
So do you think there's reason in the risk profile to have that be like a setting, default to 3-day, you can look at 7-day, 30-day?
Yeah, I mean, the issue there is you're going to have in the risk profile, you're generally going to have a bunch of different positions on, and
Right.
and you the risk profile in my eyes is more for the next week, 3 days,
Right.
whatever, because you want to just make sure that you're protected, around these times, and then you'll have so many positions on. Like, so when we do a risk profile with all these positions on, I mean, we have literally hundreds of positions that you could see in the risk
Yeah.
profile. And if you had it 30 days, there'd be, it's not realistic, because some of those are 0 DTE ones, and so you definitely don't want to do that.
Right.
But yeah, my overall, I mean, this kind of mirrors my overall. I'm generally long, but now I've got a lot of curvature to the downside. I don't have a lot of loss, but I do have a fair amount of theta. So, but this is how I want to be in times like this, in uncertain times, as defined by higher volatility. And again, one of my favorite indicators is that 60-day implied volatility, kind of moving above the 20 days moving average of the 60-day volatility, goes above the 50-day moving average. And so that's what I kind of like watch. As it starts to come back down, I start to get less concerned about the market, but I'm concerned about the market right now.
Yeah, that's reasonable. I like what you said about kind of going back to the optimizing. I think a lot of people make the mistake of trying to optimize a stock. In stocks, they're reacting to market news, right? They're reacting to the stock announcements. You can see that in the earnings history. How much the stocks move, but it's definitely, I've seen a lot more success in just picking a strategy that has less to do with the day-to-day reactionary stock market news and more to do with just volatility, theta, and things that are.
Yeah, you bring up a really good point, because anyone could say something on YouTube or on TV, but the people that are putting their money where their mouth is are the people that are trading, right? And if they're buying, it's expensive to buy these 6-month implied volatility, but you can see how much it moves. And and you could also see that they're generally right. I mean, look at, what is this, COVID? Yeah, so COVID, I mean, you could see when the volatility started going up, this nailed it. You could see earlier in 18, it nailed it. You could see when was that? Is that the flash crash? Yeah, this is the flash crash area. It got some of that. It was difficult to get the flash crash, I should say, because it was a flash crash. And even the smart money missed that, which generally doesn't. And then, but you could see that it also, it's 2008 and 2007. It might not have been in as long as you wanted, but it was there for a while, and it kind of head faked and went again, that it missed. But that's
Right.
It's going to happen in some of these. And with some of these indicators. And I'm talking about wanting to get out as soon as it comes down, but then you might miss this kind of other leg that it missed here. Like, so there's the green and the leg that it missed. But for the most part, it's pretty awesome. I mean, it's hitting all of the times when it when the market moves. And recall as well that this strategy is a long put spread that actually captures 300% profit. So it will get out, without, it will get out of the position for you. So it's capturing a bunch of these too. So not only would you get out of it, this would get out of it for you, if that makes sense. And
yeah, I want to make a quick note about the how we do our backtests in the browse backtest tab. So there's over 300 million across over 100 different symbols and 15 different strategies per symbol. So the way we do it is really important when it comes to some of these longer dated strategies. You might have noticed that one we were looking at was, what was it, 100 DTE?
yeah, 75
so
DTE.
Yeah.
And 100. We
yeah.
looked
So
at that too.
yeah. So those really long-term strategies, they can be very path dependent, but we basically take out the path dependency by averaging the returns every day,
Yeah.
entering it every day, and then weighting the returns. So
Yeah.
it's not a practical approach. Like, you're not going to trade like that, but it's very useful for comparing backtests by themselves to other backtests and also optimizing the backtest. So yeah, Matt's pulled up the trade log here. You could see that it's trading every day, which, yeah, at first glance you might be like, well, it's a 75 DT strategy. Why would it do that? That helps us smooth out the path dependency so that we're not vulnerable to starting date bias.
And you could see, and when you say starting date bias, I mean, you could see, like, if you got in on the 6th, you made 2,000. If you got in on the 7th, you made $500. Yeah, that's a big difference. So, there's a lot of path dependencies and that's what you bring up, a very good point. And you also said that it's not that realistic to trade that way. And that's true too. In my case, I like to trade like every 15 days or something. So, it kind of, because if you only trade every 75 days or every 100 days, you're really going to have a lot of path dependency. So you want to,
yeah.
So what we've learned from all these backtests is that you want to stagger it a bit, and to not get lucky on a certain entry strategy.
Yeah, I mean, it kind of, if you look at ORATS and our indicators and our back testing methodology, we're all about, we don't want you to be fooled by the luck entry and exit points, right? It's all about P values. It's all about reducing path dependency, reducing overfitting, all that kind of stuff. I kind of see it similar to like dollar cost averaging for, traditional stock investing. This is kind of like your dollar cost averaging the options trade.
Yeah, no, you bring up a very good point. And what P values use are kind of a Monte Carlo simulation. So, and then the whole point of this webinar today is forward testing. So you're doing, not only are you like modeling this out, maybe unrealistically in the to generate kind of a return stream here, but then you could also make a custom backtest that maybe would trade more similarly to how you would trade. So getting in every 15 days on a 75-day to expiration, but then you forward test it, and then so then you compare that. So this is it's just not one and done. The people that I used to back traders. The most successful traders were the ones that stayed afterwards, studied what's going on. In anything that you do, you have to put the time in. There's no easy way to do it. You got to put the time in to be successful. So, and that's what ORATS could help you with.
All right, thanks, Matt. Yeah, I think this was a great show, and we covered a lot of very important subject matter topics on path dependency and optimizing p values, and kind of how to use the backtest finder, the browse backtest tab, in a way to help you navigate the volatile market conditions we're experiencing. So I think this will be super helpful to traders and the ORATS community and the Tradier community. So I think this was a great show.
Yeah, I appreciate that. And, thank you for putting together such awesome tools that allows us to find these things, right? So,
yeah.
Yeah.
Cool. Thanks, Matt. If you guys have any questions, you guys can email support@orats.com or ask Otto in the top right of the dashboard to get some immediate feedback. It's our AI chatbot. And feel free to reach out and comment, and we'll see you guys next week. Thanks.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.